Joe, by the way.
No,
We bring the big names and we have the big fun. I was like, it's 7:35. We got to do it. So hey,
Go live.
7:37. So how you going anyway, Aaron? What's happening?
Oh, I'm on talking with you guys tonight. So it's been an incredible day, and even better to be here.
It's a roller coaster ride, isn't it? When you come on and we're throwing things at you last minute. We're like, what's it all going to be? What is it going to look like? But how good is that though? How good is life and lending at the moment? But,
It's incredible.
Yeah. And we'll talk a little bit about that in the pre-chat, the sort of the preambles before we get into the meat and potatoes. But because I'm excited to hear Aaron's perspective. But Joe, how are you going anyway?
Oh, mate, I am fantastic. I am ready for this one. I love having Aaron Whybrow, the absolute expert mortgage broker here, the lending scientist that we've got, because this is one thing. Like back in the day, you used to just say, hey, I want to buy a property. And they'd say, yeah, mister, I'm a bank. I'll give you the property. Not anymore. The banks have lending criteria. You hit this thing called a serviceability wall. You hit this wall, and it's now not a game of, bricks and mortar, as they say. This is just a finance game. And I see it all the time. I see all these crazy property investors that love property. They love investing. And then they throw all their money at some investment, and they hit their serviceability wall. And they're like, oh shit, how do I get to that next level? How do I actually go beyond that? But they may have started their portfolio. Hey, I've got $1 million borrowing capacity. I'm going to buy a $1 million property. That may not be the best asset for them. So I'm excited, mate. Sorry, I went on a tangent there. But Jeff, how are you, mate? How are you?
I'm excited, man. Pretty relaxing, sort of, but also a chaotic, sort of not chaotic, but yeah, managed to get out for a lunch date today with fun times. We went and visited a local temple, which is nice little vegetarian. But yeah, anyway, you don't need to know about my day.
Vegetarian temple?
No. So there was vegetarian at the local temple place. If you know Wollongong, you'll know which temple I'm talking about.
If you know, you know.
So yeah, you're talking property. I'm just talking about how my day's going. But no, so what are you up to anyway, Joe? What are you cooking in the next month for Oz property investors? What's going on?
What have we got in the lab? I feel like this was a very scripted question because we have a lot cooking, guys. We have a lot cooking up. We are actually running Oz Properties' first ever live event in person. I realize we run live events every single night on a Wednesday at 7:30 p.m. However, this is Oz Properties' first ever live event in collaboration with the amazing Sophie, who is in this group, who is an amazing property manager in Geelong, REG Group. So we are going to do it. We're going to do it. So anyone that is in Geelong, anyone that is in Melbourne, it's 40 minutes. Jump on the Melbourne thing. We
need more than 40 minutes from Melbourne to Geelong, isn't it?
Well, it depends what part of Melbourne you're in. If you're in bloody Frankston, it's going to take a little while. But if you're on the western side of Melbourne, hey, come on by, say good day. So, yeah, we're running the first ever live event with these guys. We are going to have 6 speakers. All of the proceeds, it costs $30 to attend, and all of the proceeds go to a charity called Friends in Me. So that is how we're going to run this thing. So please, I met up actually with some of the group members that we have just today. Come to the event and donate to an amazing charity and learn a couple of things. We're going to be doing a lot of posts and promotion about that. So this is going to be cool. This is our first ever one. We've got 37,000 people. I hope all 37,000.
38,000 now, I think.
38,000. I hope all 38,000 can make it. We're going to be at the Black Sheep, 5:30 p.m. on June 14, this coming June.
And just so I suppose it's not like I want to give kudos to Sophie. Like she's the one 100%. She's the master coordinator of all this. She just said, do you want to tag along? I don't want to sort of, just so we make that clear, Joe.
Yes, it's very much in collaboration. And by in collaboration, I mean, Sophie has done all the work, and we're going to slap Oz Property banner on top of it. So thank you very much, Sophie. But it's going to be a great opportunity. Like, this is how you and I met, Jeff. Aaron, we actually met through this group. So it's a good opportunity to meet people that are like-minded, because before this, I had no friends that liked property. I had no friends that wanted to talk about property. I had virtual friends, but it gave me an opportunity to meet them face to face and create some amazing deals. A lot of the people that I deal with in my day-to-day now, I've met at these type of events. So anyway, that's enough talking about our event. Are you coming, Aaron?
Oh, I've just written it down. I'm hearing it firsthand right now.
Check the schedule. Who is coming? Who is interested? Throw it in the comments that you're coming. I'm already. No, okay, sorry. I'm getting too excited. This is going to be a good day. It's going to be cool to meet people as well. And
thanks for letting us indulge there as well, Aaron. Let's get on to the live. Let's get on to the focus. The lending scientists. I'm excited about this session because to give you a summary as to what you're going to be seeing.
Please.
I realize that we talk a lot about how to borrow more and all that sort of stuff, but we've never really unpacked the sort of the people starting of it, talking things about like fixed loans versus variable, principal only versus interest only. So we'll have a bit of an intro on that, which I think is really fundamental. And if you don't, I think it sounds very basic, but I think it's important it gets us in the group every sort of couple of days. Like what should I go? What should I do? So we'll sort of talk to. It
sounds basic, but it's like you never come across it. Like you don't think about it until you get asked the question, and then someone just goes, "I'm going to go interest only. I'm going to go principal and interest because I want to pay down the debt." Okay, but why?
Yeah,
Here's
exactly.
Why.
That's why I think we've had many brokers on, and then we're going to talk to what Aaron calls the company sort of structure or company. I don't know what do you call it? I call it the multi-lender strategy, but what do you?
Well, I talk about a platform bank that's your starting bank where we can get all the stuff, and then we build with the other banks that have a little bit more lenient policy as we go forward.
Yeah, exactly. And then the bigger, more advanced is the trust sort of structures, which is I consider almost a holy grail of lending. Which you're not going to say you have unlimited borrowing capacity, but you can work out ways that you can continue to keep sort of funding purchases as long as you meet certain criteria. So that's I'm excited to go from the beginner or the sort of across to the advanced sort of stuff. So we're going to have examples.
I like to call that the infinity borrowing capacity. How to have infinity borrowing capacity through the use of structures, trusts, and companies. Because
sounds a bit spookery. I don't like.
Sounds spookery. It does sound spookery, but it's not. You can do it. I've seen Aaron do this in the day-to-day of turning someone that could not borrow property to be able to borrow property. But we'll get to that to the end because I think it's very good to build out the foundational stuff and then jump into
the quote of the week, gents. Let's do it. Aaron, what's yours?
Oh, so I got the really cool one. Well, I'm only saying that because I haven't heard you guys yet. So, so the best investment you can make is an investment in yourself. The more you learn, the more you'll earn. And that's a Warren Buffett one. I thought it was quite important because you've got to learn everything about the investments and the properties and all that stuff. And then you'll be able to go in eyes wide open instead of just going after it and buy one and get stuck. And then you earn.
Wow.
The more you earn, the more you learn?
No, other way around.
Okay. Do both.
The more you earn, the more you learn, the more you earn. Yeah. No, that's an amazing. Like I thought you were going to go the old chestnut of the first rule is not to lose money, and the second rule of investing is rule number one. I thought you were going to when you told me it was going to be a Buffett quote, but
you sneaking your quote in there just there.
No, that's
like
the
sneaky
not
quote in there.
I got one that's much less about money, but talks about money ironically. So Joe, what's yours, man?
I want to hear yours.
Okay. All right. So I don't think I've ever quoted this person. I'm just amazed. Like I used to be a self-development junkie or groupie back in the day. And so Jim Rohn is my quote. And he said, time is more valuable than money. You can get more money, but you can't get more time. So I think that's foundational to what we're talking about tonight. You can use these strategies to get more money, but I think you really need to uncover and unpack what it's all about. It's hopefully about creating more, but freeing up yourself to do with what you choose with your time. So I think it's really poignant and important when we're investing.
I like it. I'm all for it.
So you've gone a bit kind of your camera's a bit. I think it's a bit light, is it or?
Light and bright, baby. That's what I'm
Oh
all
no, it's
about.
the other way around, like a bit dark. Yeah.
Yeah.
Oh, have I gone dark?
No, mate. You're all good.
No, it's
On my
me.
side.
Sorry, it's my bad.
Your computer started to go to sleep, and you're like, "Oh God, this is really hard."
It's getting dark.
It's not just me, mate. It's not me. It's you. My quote of the week is: I was thinking about this. You either win or you learn, and I used to really like that quote. And then I was like, "But why don't we just do both? Why don't you just win?" And then learn as well. So I feel like sometimes I hear all these quotes about people like, oh, you either win or learn. No, just win and learn. Because there are some quotes out there that make people like, oh, it's okay if you just kind of learn as well as win. No, just win. That's that. So it's not really a quote that I want to say is a great quote. I would say, don't lean on quotes as an excuse not to learn. Win as well. Win and learn at the same time. So a little bit of contrarian quote this week. Please feel free to throw some shade in the comments if that is a dicky thing to do. But I think we're going to do it. Okay.
There you go.
I'm excited to learn who Aaron is, why we've got him on. I mean, we covered why we've got him on. What we're going to cover. So anyway, let's just dive into the...
The amazing thing with commercial property investing is that in most cases it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yields, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Polisi of Polisi Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you. With 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia, and not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
Look what I found.
Oh, no way.
No.
Crazy.
Just shouting it out there for you, Steve.
There you go.
But no, he also said that it's actually 100% off still, so he hasn't changed the code yet. So go and now there's almost 100 people watching this at the moment. So go and jump on this link and send Polisi bankrupt just for for being too lazy.
Lazy Polisi, that's what we call him.
Kind of sounds like something I'd do. No, I wouldn't do that. But who is the person in front of us? So Aaron, you've been on the show before. We called you the lending scientist, but you are actually the bagpiping broker. And I've mentioned this before. You've done 3 careers. You've worked in intensive care, an adult nurse, and medical sales rep, and a broker. That's very very diverse, but quite complementary kind of skills. You've done an MBA in business admin. You've got a Bachelor of Nursing. I'm not going to read out all your qualifications. You've got hundreds of them. But the thing I love about yourself as well is it says that you've done an ads as a bagpiper with Delta Goodrums. That must have been fun. How was that?
Yeah, it was fun. It was an interesting ride on that one. I went full time in my business, and then I had a little bit extra time, so I went. I was first in a Hahn Superdry TV commercial where it had You're the Voice and horses, and they did that over at Concord Bowling Club. And then I got called a couple of years ago. I got called up. Oh, can you just jump on a plane, go to Melbourne, and be in the Delta Goodrum's rendition of You're the Voice? So I'm part of bagpiping pipe band. And then I've been able to do other things like anything from street parades for an old bottle of scotch through to weddings, funerals, Anzac Day recently.
So you're
awesome.
doing Anzac Day, or you were hitting it up.
Yeah, I had 3 services to do. Yeah.
I mean,
it was good. It was lots of fun.
I really wish I could play an instrument to be able to contribute to something. Anyway, I won't go. I'll go on that big tangent. But anyway, so that's you're a absolute sort of you do heaps of really cool things, and I suppose the time you always have time though to jump on the phone or even often see photos of you hanging out with your kids as well. So that's, I suppose you are able to have that time whilst also kicking plenty of goals. So. What I wanted to say as well, if people have comments or questions, drop them in. We won't promise to get to all of them because there's heaps of people that are registered. So it's very exciting. So shall we kick things off with an around the grounds of what's new in lending at the moment, Aaron? What are you sort of seeing? What should borrowers consider if they're applying for finance today?
Oh, so everything's changing quite dramatically. A couple of high level things is a lot of lenders are putting the calculators online. So they have the ability to tweak that very, very quickly on you. So one day it might work, next day you might have to tweak a few things. There are some changes with some of the non-banks around how they're servicing new debt. There's a couple that have moved to 2% buffers instead of 3%. As the interest rates rise, each bank has what we call in-flight application rules. So some won't lock in that assessment rate until you're formally approved or conditionally approved, or when you hit the submit button, or all that sort of stuff, or they have discretion on that. So that's a really interesting thing. Living expenses are great. They are changing all the time with inflation going up and cost of living going up. They are benchmarking them higher, so they're responsible in the lending space. And there's some really interesting things of what they're doing there. And the other one that's really interesting is we get a couple of lenders that just delay putting RBA rate hikes on. So just today I saw a lender put up their rates by 0.5% because they might have forgotten to do it before.
Wow, there you go.
So that's a little hit to the
somebody must have got
to those
somebody
ones.
must have applied.
My little tip, my bank raised my interest rates by $700 a month on a $600,000 loan. And like you just get this email and like, yeah, by the way, I just casually, by the way, it's going up $700. What should I do, Aaron? What am I doing?
Okay. Casually.
How much percentage was that, Joe? Anyway, like why was
well,
it?
They didn't say the percentage and they didn't say the interest rate. Just on the email, it said, like, by the way, we're going up 700.
It's like your kidneys, Joe. That sounds like you're in trouble, mate. You okay? Like you.
It's
scared.
It's like
I'm scared for you.
I'll be okay. But what do I do, Aaron? I just got this email. How do I fix this? How do I solve the problem? And by the way, I haven't spoken to my broker. I haven't spoken to the bank in like a year.
Yeah.
So it's just me being lazy and not asking for a reduction. But what do I do? Help me.
Oh, I think there's a nice little tool. I think there was some information I threw your way to be able to put it into one of the chats or the group before. So yeah. I would first, if you've got something that's coming and say you're going to pay $700 more, I go and investigate that. Go log into your bank is always a good thing. Check what your rate is. Check that that's actually a real email. Check that it's not spam or anything, because in this day and light, it's really interesting. Make sure that your repayment is in line with the rate. And if you feel like the rate is too high, you can contact your broker, and they can do some pricing in the background. Most of the banks allow us to do pricing. If that's not going to work, and there's a couple of banks that you may have to ring up and ask for a deduction. I've had people ring up for a deduction. They got a 0.9 off within 5 minutes of a conversation. That's a person that was a bit lazy, didn't ask for anything. And as we know, banks are not geared up to keep your rates low for existing customers. They love to get the new customer. But if anyone listening in business, is it better to hold on to a current customer, or is it better to go after a new customer? What's going to cost you more? So you've really got to keep on your banks and make sure that the rates are reducing. In the past, I used to do it every 12 months in the past, but I stepped that up to 6 months, and now I've even stepped it up further. So we've had 11 rate rises. So I'd ask until they say no.
Yep.
Yeah. And that's what I would do. Ask until they say no.
Yeah. And the reason why, so I called them because I was like, that is an absurd amount of money. What has happened? So this was, do we mention names? Oh, speaking of, we do have a little disclaimer. We're going to talk about a whole heap of financial stuff. And none of this, Jeff, do you want to make me big? There we go. All of this, none of this is financial advice. We're not liable for anything. This is just three blokes having a chat about property and stuff. So yeah, speak with your financial advisor, speak with your mortgage broker, speak with your professionals, do all of that stuff. But yeah, essentially what I did was I called them up. It turns out the valuation of my property in RP Data's eyes, which is what they use to value the property, has dropped for some silly reason when it's actually grown up. So it dropped by $100,000, which sounds ridiculous. This is for my PPOR, a property that I own in Cronulla. So it doesn't even make any sense because the market's actually bouncing back. So I called them up and said, what's going on? They said, hey, the valuation's dropped, which then has taken you out of the X lending, blah, blah, blah. So we've got to raise the rates.
Yeah, but you'd be potentially above 80% LVR. Or was it above 70?
It was above 80% LVR. So what happens in that situation? Like, does that happen all the time? Is this a new thing? Is this a Joe thing? Am I just lucky?
This is like a Joe thing.
We love to say it's a Joe thing, but I suppose lenders can review and redo everything all the time. I haven't seen them increase rates on people where they've had a current rate because it doesn't look too good. Like you're talking about it now on a Facebook group of 30,000 people about banks actually increasing your rates because the valuation has dropped. And a lot of banks have taken the pricing mechanism of if you borrow under 60 or under 70 or under 80, you get different rates as you go up the tier. And what's been happening, and I've found with the major banks, as soon as you go from 80 to even 81, they're jumping like 0.75 on the interest rate there and hitting you with the LMI. I find it hard to believe that they can actually justify that. I'd be interested to see what their data is. And I would imagine that you would have some comparables or anything to challenge that to go back there. Or you can, or in this case, if it's RP data, force them to do a revaluation. If you're with a major bank, they would probably do that with limited no cost to you. If it's a non-bank, obviously there might be a cost to the valuation.
Yeah. And that's exactly what I did. I said, hey, let's jump on real estate together and go through 2-bedroom units. Yeah. Nothing is sold under what was it, 800,000 or 700,000, whatever the number was. And we went through it together. And then I'm like, get your manager, blah, blah, blah. We covered it off. This is obviously not valued at the low end of the range. It's valued at the high end of the range. And they're like, yep, we agree. Great. We'll drop it down. We'll drop your rate down to X percentage. So if you do, so I guess that's kind of a story. If you get a big expensive hit, have a chat with your lender and find out why. Yep. The first comment was, oh, interest rates have gone up, but that didn't expand why it went up so much. So anyway, either way, they reduced my rate. It went up higher. They agreed to the rate, and then I called them up and dropped it lower. All it was a 30-minute phone call. Now, 30 minutes is a long time to be dealing with this nonsense. However, this is what is it called? What's it? You bend down to pick up a penny and you drop a pound, whatever that saying is, because when you're dealing with these little bits of number, people are like, oh, I want to save $5 on a latte. I don't want to get a $5 smashed avo. No, you need to be focusing on the large percentages that are costing you hundreds of dollars over the month when you're trying to save $5 here and there. So focus on the larger items that are taking those expenses from you.
Well, you can expand on that a little bit more, Joe. If you're talking about your own place, so obviously it's non-deductible debt. You want maximum cash to go off that to get rid of that as soon as possible, and then recycle it into investments. But what if it was an investment and it goes up by $700? You've got rent coming in, you've got other expenses going out, and now your cash flow on your investment property has been hit to hold it. So I've found a lot of reviews of investment property investors to get that 0.7, 0.9 or even 0.2 off your rate can change your cash flow, in addition to other things like rent going up, negotiation property fees, negotiation or even on insurances, and a whole range of other things that can come into it to not only cope with the interest rate rise, which has inevitably happened, but also try to manage that cash flow with all the other mechanisms that you probably should review as well, which is outside the lending game, like insurances, property management, all that sort of stuff.
100%.
There you go. That's a story and example. I said we'd have stories and examples, so there's one of the first ones. So let's get into the intermediate. Let's get into the beginner, not beginner, but yeah, I don't mean to disparage anybody who isn't aware or hasn't sort of thought about these things. But, let's talk about interest only. We'll talk about a couple of different things. Probably the first question I want to ask is, how do you typically treat a customer or a potential client that comes to you and says, "Hey, Aaron, I want to get the best rate." Like, how do you, because I'm sure you get that probably every day of the week. Well, how's that conversation usually go? Like, how do you?
Well, it's what are you currently on? Like, one of the things when people come in for the best rate, everyone wants the best rate. And as you go down the property investment journey, you will find that as we get to more and more properties, it can take a little bit more time to get the numbers done, the numbers crunched, the borrowing capacities done, and those sort of things. But you'll find that the rates will be what they are off the shelf, or a little bit of negotiation when it's down the track. So when you're early on going after rate, or we've even seen some cashbacks leave the market with some of the banks at the moment. Rate is not the big determinant when you're going after property investment. I always look at a person, and it's a person that comes in to talk about lending, about what are their circumstances and their goals. Then it's about the policy of the bank, and then which policies do they match up with their goals. And that enables the client to understand when they turn on the TV and they can see everyone's really hot rates around the market. And when they think about it, they go, wait a minute, Aaron told me that it was because of this and because of this and because of this. And if I didn't do that, I wouldn't have access to the lending anyway. So I think it's eyes wide open. Understand, you need to understand your goal. And it may not be, you might have a goal of 10 properties or something like that, but you may get your goal with 2 properties. You may get your goal with 1. It's understanding what is property investment going to do for you, your passive income, lifestyle, not being able to rely on your job, not having the business get pay you too much, or whatever is your goal, and then matching it up. And that could be people going for their 13th property. It could be people going for their first. So rate isn't the first thing that I would go after if I was to start a conversation with a broker that is competent in property investment lending. I would be going after what is your goal, so that we can match that up.
So one thing I kind of see is people going online and going to like a random lender, best rate, interest rate loan. What happens? Because a lot of what I hear from you, what I hear from expert brokers is say, hey, get your lending set up with the big 4 first, CBA, NAB, ANZ, hit those guys first, and then start, as your borrowing capacity limits hit, then start looking at those second and third tier lenders and some of these online lenders and things like that. What happens if we go with one of these, we get a loan with one of these smaller lenders? Why is that such a bad, why is that not the best strategic move? Why?
Yeah, so to put a bit more context around it, I call it a platform bank. Now, there is no bank out there called a platform bank. It's like any building; you need a good foundation. So, why are the specialist brokers talking about Big 4 or those ones? Because they got the bank accounts, they got the offset accounts, and having all the strategic mechanisms of why you would have an offset account on an investment property versus an owner occupied, and how that works with combination of talking with accountants through to multi splits. So if you're pulling out equity out of your principal place of residence, you can split it off so that you are able to demonstrate that that was for investment purposes to buy the investment property. You've got all these flexibilities once you've got the loan in place with these big four, if you want to pick on those guys. There are some other banks that have an ability to do the splits and the multi offsets and all that sort of stuff. So they always have that. And then they are typically also more restrictive in their lending. They're regulated by APRA versus ASIC. They are more audited by the regulators. They are typically more restricted. They investigate a little bit more about the borrowing. And there's some that don't, and there's some that do. But in the main, you want to be going for the more restrictive lenders first, because as you start going down the line to the less restrictive, you get more borrowing capacity. So if you go straight to your question, Joe, if you're going to the lenders that give you the most borrowing capacity first, the new borrowing is still considered similar to the big four. For example, they will add a 3% buffer or a 2% on the new money. And if you've got multiple loans with that particular lender, they would consider their loans with the interest rate plus the 2% or the 3% buffer on their loans that they currently got. So all their money is considered a higher regulatory and environment. But what's strategically different is that if you've got money owed somewhere else to another bank, they take an impression that that's the responsibility of that bank. So that would be so if that money is paid at $1,000 a month at that bank, this less restrictive lender would take $1,000 or $1,200 or they might have different funky mechanisms to maximize your borrowing capacity because that debt's not their responsibility. They have to be responsible with the new debt they're getting you into.
Yeah, so on that, I know Joe's probably got 100 questions about that, so sorry, Joe. Yeah. But when Aaron and I were chatting earlier, you I believe you produced a chart or a scenario. So and yep. I do want to talk about the principal and interest and the fixed versus variable as well. We'll get to that because I think that's important as well because that plays into this. But do you have that chart you can bring up for us, Aaron? Or?
I actually wrote it down.
All right.
Paint with your words.
I'll try. Well, I went. How am I best going to demonstrate this? I've got 3 screens in front of me, and I had 3 different calculators up. So what I did is I took a starting investor, and then I've also expanded on a multi-property, multi-structure investor to show you what the differences are between the borrowing capacities. So I've got so picture this. I have a single person, male or female, doesn't matter. 1 child. I've got $160,000 worth of income. So, yep, going pretty good. I'm taking a 4.5% rental yield on an investment property. They are renting at the moment, and that's on about $650 a week in rent, maybe so $700. A rent vesta. And they got 1 credit card because they want some points to go fly around or wherever they want to go. So the credit card's about $5,000 limit. When I put it into the system, the lowest lender was going to give me around $481,000. The top of lenders were going to give me $668,000, which is a $186,000 increase in borrowing capacity across the lenders.
So what was the existing? So was there some? So they haven't bought a property yet.
Haven't bought a property yet, just starting out.
So you're a single person earning $160,000, and the first bank gives you $400,000 as lending.
With 1 child though, so you throw
with 1 child.
And on that point, how much if you take the child out? We don't want to just make somebody disappear, but what does that? What does that do
out of a picture? But
let's discover that they.
Can we put a child in a trust and just kind of hide them?
So what happens is if we take the child out, our low lending point goes from 481 to 543. So there's about a yeah. Then the other thing we can do in this one is obviously there's not much mechanism to remove the rent or remove living expenses, but we can remove the credit card. So it's a $5,000 credit card. We can remove that, and our borrowing jumps to 568 on the lower side. So in just 2 things like a dependent and a credit card, we can change the borrowing capacity outcome.
We're not suggesting you should remove dependents from your applications, by the way, people.
No. There's you have to have your dependents in there, and most of the time they're asking for Medicare cards and things like that, and that gets to disclose them. And if you are able to justify removing dependents, like if they're working full time, they're not living at home, they're over the age of 18 and not financially dependent, that's a conversation to have with your broker too.
What if I'm a single parent and the kid lives with mum and I'm the dad?
That's the reverse way. You want to get rid of the dependent now, do you?
Yeah, I want to get rid of him. But you don't think about it, right?
You're paying child support though.
Yeah,
hopefully.
So if you don't have 100% custody, you're paying child support. So that goes in as a liability. And if you have any sort of custody, you're better off putting the dependent in just to be compliant and safe.
Because you could go through the entire process of trying to be dodgy, and then at pre-approval you get the contract underdone, and then they find out, and then they rip the contract out, and then you can't serve the loan.
This is why you use a mortgage broker well-versed in investment so that you get everything dot the I's, cross the T's, and you can afford it, and you've got a way to manage it going forward so that you can do the next one to get to that goal, whether it's passive income or legacy, intergenerational wealth, all that sort of stuff.
But I guess the moral of this story is, well, one, here's the moral of the story for one of our Facebook users. Moral of the story, don't have kids. But the moral of the story that I'm getting is, just because the kid's not 18 yet doesn't mean you shouldn't think, I can't invest in property, right?
Correct.
Like, it's either kind of that I win, I learn scenario. No, I've got kids, so I can't invest. No, you've got kids, but there's still potential there with some other lenders. So have a think about that.
I started investing with 3 kids, so. No. And it's still possible. Yeah.
Love it. Okay.
What
else can we pull from this scenario?
So that's the simple pull out a single applicant dependent, little bit of variability there. Well, here's the other funky one. If we look at a client that has multiple properties in their personal name, in structures, and a whole range of other things. Now I can show you. I'll describe to you. So I found that between lenders on this particular scenario, $687,400.
What's the scenario? Give us the brief.
So I got a couple with a child. They're self-employed with multiple entities. So there's multiple trading entities. They got properties in their own name and properties in trusts, and their total count of properties, including everything, is around 12.
A baller, what we call that.
Yep. Self-employed, obviously there's a lot of variabilities in the income there. So I've just taken, I won't go into all the detail there. We'll be here for a while because there's multiple trading entities here. So one lender, the more flexible lender that's going to take your actual interest, actual repayments at whatever the lender says. If it's $1,000, they'll put $1,000 in as a liability. They're going to throw another $1,037,000 at this client. Then the lower end lender is going to throw $350,000 at him.
Wow.
So there's a $687,000 variance between lenders when you have a lot more variability in things. So you got a lot more properties, you got a lot of trusts, you got a lot of self-employed, multi-entity stuff. When all that comes into it, the variability can be very different between one lender and another. And the same principle remains when I'm looking at a person that's got multi-properties, is that we're stripping it back and we're doing getting all the valuations, we're getting all that in, and we're stripping it all back. Is that we may still choose the lender that's going to give us the 350, the 400 to start off with, because they're the more restrictive, versus going straight for the jugular and going, cool, I've got $1 million, I'll just go to that lender. So we're still going to be strategic in what we're doing. So as a broker, I love to have 2 options. I love to have the option that we're pursuing, and I love to have the option that would back it up if something got a little prickly, or a subjective assessment on the file or something like that. So when you've got a lot of variance, that's where it usually comes in, when you've got a lot of things going on, and you just got to, for me, I've just got to understand where it's going, what the goal is, and then we can make the strategic conversation about what we're going to recommend or what we're not going to recommend going forward. Clients can choose anything with a broker. Like, we can recommend something, you can go, no, that's crap, I'll just go with that one. That's fine, but it's good to understand the justification of why we're recommending one thing over another.
100%. Yeah, that's awesome. So one thing that I actually heard just recently, I had someone come to me and they said, hey, Joe, I have $800,000 to borrowing capacity, and I want to buy 2 properties. So I'm going to buy one $400,000 property and then another $400,000 property, because that's all I can afford with my borrowing capacity. Is that the way it works in borrowing capacity world? You've got 800 to borrow capacity. Someone said, an online bank things calculator said, but is that reality? To even make it really more interesting on your question, just to make it a bit more challenging, even though I'm answering it, is that if you get an $800,000 borrowing capacity and you go buy a $600,000 home, and then the client turns around and goes, where's the other $200,000? Can't I do some renos or anything with that? So similar question. If someone has an $800,000 borrowing capacity, that's awesome. But the next step is to understand how is the deposit strategy. So
a lot of multi-property investors or investors come to me and they go, I've done some online calculations. I can get to this borrowing capacity. And then we unpack, where's the deposit coming from? Yeah. So I've had people on, I say $500,000 worth of income. They got borrowing capacity out to wazoo, but no deposit. So they can't do anything. Then again, you can have the person that's, as we said before, $160,000 of income and a good deposit or available equity, and now we're able to go, okay, we pull the trigger on the equity, pull the trigger on the loan on the property, and away we go. And that also helps with the loan to value ratios and all that stuff. So borrowing capacity when you're using equity has a mechanism of being very similar to what you can purchase at, maybe a little less than borrowing capacity because you've got to accommodate stamp duties and stuff. And where you got deposit, that obviously, if you take the Rentvestor, my fictitious client here with the 160, if they've got 150 grand of deposit, that could help them get up to that sort of $500,000 or into the mid to high fives to go and purchase a property. So it's always a combination of borrowing capacity and the deposit strategy around cash equity.
Yeah. So it's not fair to say I've spent 400,000, so I have another 400,000 to go. You could actually have another $600,000 to go. You could actually, if you've got the capacity. What about when? Well, actually, we had a person message in. They had a great question, which I think ties in quite nicely to this. I'll ask it just.
Not so much that it's not fair, Joe. I reckon it's just that it's not accurate because it's not the way that it plays fair? Out.
Sorry. No, it's just not reality. Like,
the other thing people think too, and this is where you need to understand, are you going to go for two properties at once or go in sequential order? Obviously, if anyone's had an experience of settling on two properties at once, they will see a whole range of different things that go on. If you go sequencing, you're able to then settle on one, get the actual rent, readjust, and then go again. And when you're doing two at once, you can't just get one big pre-approval, because that pre-approval is for one property only. So if you've got $800,000 pre-approval and you go for 400 and you go, where's the other 400 to go to another property? That's a separate application again. Yeah. So if you're going to go for two at once, you've got to do two separate applications.
How when you're sort of planning, if somebody came to you and said, hey, look, they come up with 800K borrowing capacity, and then they say, well, actually, I want to buy one within 3 or 6 months. Do you kind of punch in the yields and sort of look at what that's likely to do for the second purchase?
Oh, absolutely. I always find if I understand the second and third play, it makes it easier to do the current play. The first one. All right.
Yes. So that allows gold. Yeah. This is something you'd never hear from other brokers because it's hard work to identify. So that's one key thing to take away. Whatever Aaron's going to say next, put it in your little save file, however you do that of your brain. But don't look at what this next purchase needs to be. Look at what the other purchases after this need to be, so you can create what this one is. And love it. Okay. Anyway, sorry. I feel like
here's a point. Do it. Can I expand that a little bit more? Like this is where you need to, like, some people think I can't do anything. I only can do one. All right. Yeah. So I try to look at what I can do in the future. Now I'm just going to be hypothetical and brainstorm and go, oh, if you could, would you? If you could, would you? If you could put a granny flat on to increase your cash flow, to increase your borrowing, could you? Are you going to buy? What are you going to do with it? Can you convert Airbnb through to other things that have been talked about on the group? So people sometimes go, "Oh no, I can't do it. I just refinance what I've got to get me a better rate." But then when you look at their borrowing capacity and you say, "Well, actually, borrowing capacity is up here. You've got other assets. Have you thought?" Or just drop in the little seed to think about it. So you don't have to do anything, but just dropping that seed, it just opens up people's brains to think, okay, well, I wanted to buy more property. I wanted to have that financial freedom. I've now got a thinking that's going past my current refinance structure into the next property. And that's where I have a lot of conversations with people like yourself, Joe, to other people to go, okay, tell me what the average rental yield is. The range of properties you buy in, whether it's 400 or 800, whether it's one area, whether it's two area, whether it's over $1 million or whatever it is, so that you can go, okay, well, if I was going to go for $1 million properties at 1% rental yield versus a $500,000 property at 6% rental yield, it's going to change your borrowing capacity. So that's what we've got to model out a little bit and have a little bit of control around that. Not that the actuality doesn't change too much, but that's my mechanism of thinking further, is one, triggering you to think that you can do something more. You don't have to. And number two is always think, if you know what you want to do, tell me you want to do 2 and 3 in quick succession, so that I can go, okay, well, bring me into your accountant's financial, tax planning meeting. So this time of year, a lot of accountants with self-employed people are doing tax accounting, tax planning meetings. So let's not have your accountant make you look broke to be able to not borrow, because your goal is that. Make sure you communicate with them about that. And there's a whole range of things right there that can help you figure out your goal, tell your broker your goal, so that you can model that out.
That's so true. Actually, that's one key point to be very, very crucial of, that all of your team are looking out for your best interest. Every single person, your lawyer, your accountant, your mortgage broker, your buyer's agent, they're all looking for your best interest. However, they are experts in their particular field. You need to have them all talking together and communicating, because an accountant is there to save you money on tax. Is saving money on tax the best thing from a broking perspective? Not necessarily, because saving money on tax means that your income is going to be lower because your expenses are higher because you're saving money on tax. Your buyer's agent is going to look for the largest capital growth perspective. But Aaron, you're not going to want the most capital growth perspective. You're going to want the most cash flow, because that's going to allow us to continue to grow again. So a lawyer, they're totally thinking about risk. How do we de-risk this investment? So it's only until all 4 or 5 of those people are together and having a bit of a conversation about pulling the strings and coming up with what is that ideal property and strategy. So yeah, that's a good point.
Probably unfair to say that a broker doesn't want to seek capital growth. I mean,
no, I don't. Of course,
I know what you mean. Sorry,
of course they do. But just, Aaron, would you love to see far better yields from a lot of your clients?
Oh, there's two little things on that one. Yeah, the answer is yes for my middle income area bracket, mum dad investor. That is on their income's a bit on the tighter side. But then again, if you want to get me a capital growth client, a growth play for a client that's earning $500,000, maybe single $500,000, or a couple and they're on $1 million a year of income, that they probably need a tax deduction. So yeah,
do it.
Dealing with one now, going after a property for $4 million in the city, they don't care. They just that's a nice property for them, and they do some due diligence around it. I'm not saying that they don't, but it's people have different circumstances.
Yeah. So it's not, and this is why everyone needs to be chatting. Sorry, Jeff. I feel like you're going to take it in the right direction.
Can I ask as well, Joe, and get up your kind of thing you're going to go back to? But what do you have much experience with clients buying granny or adding granny flats, and how that actually plays out from a lending? Does it help them or in reality, or because in theory I think it probably would, but how does it go in reality if you've seen much?
Well, it is a genuine reason to go back and extract equity or add value to your property as a structural change. Granny flats are a way to maximize the cash flow on a property, and even your own. Obviously, conversation with accountants and a couple of other things if it's going to be on your own, because there could be some other things there with capital gains and stuff. What I found too is that depending on where your location of your property is that you're going to put a granny flat on, your granny flat may cost the same to put on. But I've got two clients at the moment looking to put granny flats on. They're about the same cost to put the granny flat on, but one's going to get $650 a week in a more closer Sydney location, and one's going to get $450 a week in a less outside of Sydney location. So, and then when you go out further, you might get $350. So, they can be good cash play, because most of the granny flats cost about the same depending on who you buy from, but it can add cash flow in. If you can get it, you got to go through all the approvals and that's, but it is a genuine reason to go back to the lender and borrow money.
It's also one thing to also factor in is because when you get a granny flat, just because you buy the house for $500,000 and you spend $200,000 on the granny flat, that's $700,000 invested. It does not mean the valuation is going to come back up at $700,000. So it is not necessarily now, not for every single deal. It's not necessarily a capital growth equity harvest play. It's more of a cash flow play. So don't go out there expecting to, I put $200,000 in. Why is it not stacking up? A Valley is going to walk in there, say, great, you've got a shed out the back. That is now a $550,000 place. And so you need, and this is why you need to be strategic about what are the type of assets that I'm buying now, and then what are the type, where am I in my portfolio and strategy to add those extra little things.
Absolutely.
Be very careful of that, because I hear that all the time. Oh, I got this granny fund, it's really good. I'm going to extract the equity. No, you're not. You're going to sit on the sidelines for a number of years because you haven't got equity.
Just with the bank valuations on that one, the banks will treat them a little bit like God. I've had many conversations with valuers, and they can be hard-nosed. The bank can be hard-nosed with the policy to try to negotiate with them. I've had some success with getting them uplifted and changed, but that is what they're going to benchmark their loan-to-value ratio off. Yeah. That's real. It's real. They can't argue with it. Who are they going to argue with, the valuer? No, that's their job. Okay, I want to go back to the beginning of where we were meant to take this conversation. Go.
It's flown to some good worlds. But okay, so I'm an investor. I'm just going to go principal and interest. Like, why? What's the difference between principal and interest only? And why should I care? Because I want to pay down the debt. Isn't that the ultimate goal? I want the debt to be paid down. Should I be going with principal and interest?
There's a little saying sometimes I have that is, what is better than an investment property with a home loan on it is an investment property without.
Yep. Okay. Yeah. Fair enough.
So
I might disagree with that, actually, because leverage is where the value is with property. But anyway, go on. Sorry.
Yeah, you get to use other people's money to go out and buy it. But there's going to be a point. Now, I might take some flack for that. There may be a point you're going to have to retire the debt. There's going to be a point that your interest only runs out. There's going to be a point that you're going to have to choose what you want to do with the property. You can forecast major repairs in a couple of years' time. You may want to offload it because you're not the person to do the reno. So you've got to think of those things. But if we bring it back to you starting up and you want to talk about the principal and interest or the interest only conversation, there's been a little bit of a variance change in the market. Maybe about 12 months ago, there was a big difference between the interest rate you would get for principal and interest and what is going to be paid when you pay interest only, because there's usually a difference. So really basic, principal and interest is when you pay down the debt over the set period of time of the contract. So you get a 30-year mortgage, the principal will reduce in addition to you paying the interest over the 30 years. Banks want you to go to 30 years too, just FYI. When you go to interest only, you don't pay the principal component for the time that you have it as interest only. Typically speaking, most banks will allow you to go for 1 year, 2 year, 3 year, 4 year, 5 year. Most of them will be in that bracket. There are a couple of lenders that will go to 10 years interest only.
Oh, wow.
So that can be quite an interesting play. And the strategy you have with your property investment, you can have that interest only for that period of time. Now, what has happened prior to the pandemic and things was that they brought in this rule that you had to be able to afford the remaining principal and interest term as your income. So it stretches, the more interest only you get, the more it decreases your borrowing capacity.
Yep. Yeah, that makes sense.
But interest only has a marker where you are not paying the principal on your investment property. So if we take the mum and dad investor, we're going to go interest only on their first property. They got their own property, and we're going to save $200, $300 a month off not paying the principal on your investment property. You can then divert that money back into your owner occupied property to get rid of that debt. You can help build a deposit up to go again. And that can all come into that play. The problem is you might find that, what I've looked at with the interest-only rates at the moment is that a couple of the big banks now they're about 0.2 to 0.5% difference to have interest-only versus principal and interest. So it's not too much in the major lender space at the moment, which was quite pleasing to see. But when I drop down to the non-bank lender, I'm seeing anything from 0.5. I saw a 0.85 difference in the rate from principal and interest to interest-only. And I even found one non-bank lender that actually offers cheap rates. They were going to put a 1.14% on you choosing interest only over principal and interest. So once you start getting into so the financial decision, when you've got someone that's on the extreme, like a 1.14 on your investment property, principal and interest versus interest only, it's a no-brainer. There's not much difference in the numbers, the raw dollars. But if it's 0.2, 0.5, it becomes a strategy. It becomes a choice. It becomes a thing. So we've got lots of non-deductible debt. We can go down the line of interest only if it's in our interest to play the next property to the next property. If you're going to go for fast, maybe principal and interest is good. Maybe if you've got bigger deposits, principal and interest could be good, because if you've got bigger deposits, the higher the cash flow is coming off the property. If you're rent vesting to owning a property, will change your decision about principal, interest, and interest only, depending on what you're trying to achieve. Is it one property, two property, three property, or more? And then the bank you choose to, because it can have a big variation between what rate you get as well. And that may force you into one decision or the other.
One of the questions that's popped up, and exactly what I was just going to ask, is, okay, I've got my interest only for 5 years. Can you recast the loan and extend the interest only period? I'm, 30s. I've got plenty of life left. I want this interest only for 5 years. 5 years time, can I come back and say, I want another 5 years? You know what? Screw it. Give me 10. I'll take 20. How's it work? Is that okay?
You can go after and request an additional 5 years, or on your most of the time when you go to a bank, you get your 5 years, and you get to 4 years and 6 months, and you go, cool, I'm probably going to have to pre-forecast this thing about what I'm going to do. Do I let it go into principal and interest? Do I go back and ask them for another 5 years? The difference is if you were going to choose to change interest only to principal and interest with a bank, it's a phone call and it's done. If you choose to go from interest only to an extension of interest only, or principal and interest to interest only,
full application.
It's not necessarily a full application. Some banks will be a full application for you to verify that you can afford the remaining principal and interest term. So if you've had 5 years interest only, you've afforded the remaining principal and interest term over 25 years, you go for another 5 years, you're going to have to look at the current interest rates and things, and whether you can afford, whether the bank allows you to afford over 20 years to give you that extra 5 years. So it's always the remaining principal and interest term that you have to be able to show capacity that you can repay it over that time.
I think probably even the question was, could you go and do a 30-year loan again? So do a new loan altogether.
You're correct. So you can go to your current lender, or once you've had 10 years of interest only with a lender, they probably won't renew it, and you're probably going to have to jump ship into another lender. And if you can't afford the remaining 20 years by having an extra 5 years, you're probably going to have to jump a lender to get that year period reset. So absolutely, you can do all that. One's an application, and the other little tweaks are not.
Yeah. The way I like to think
an interest term.
The way I like to think about interest only and principal interest is, when you do principal and interest, you are 100% giving the bank that money, and it is paying down your debt. So your debt is reducing. So you need to, instead of being, now these numbers are completely made up and very inaccurate. So you give $2,000 to the bank every single month, and $1,000 of that is interest, and the other $1,000 is principal. So with interest only, when you go to interest only, you put $1,000 in just for the interest, and you keep your $1,000. But what you could do is offset that against your PPOR and help with that situation. But you've still got that $1,000 as cash that you can be saving for a deposit in another account. So you've then got the $1,000. You've got access to that money. Whereas when you pay down the debt, you don't have access, and you've got to go through an application. You've got to say, hey, I want to refinance my money and get my $50,000 out, blah, 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 blah. All you have to do is log into your CBA account. Hey, I've got liquidity of this $50,000. I can now do the renovation and do the deposit. So it's
or go to Vegas.
Or go to Vegas. But then you've got access to that capital, access to the liquidity, and it doesn't really affect. And if you want to pay down that debt, you are, because it's offset. So there is no difference of $50,000 in an offset versus $50,000 in a paid down debt. Obviously not financial advice and all that stuff, but just don't get too excited about principal and interest, because you're a property investor. You're not. It's all about the numbers. What makes sense for you?
Here's your other point to make. Lots of property investors would know this. If you get your individual tax return or a trust tax return, when you get to the expenses of the property, bar like the insurance and council rates and that, is that there's only one line item that says interest. It doesn't say principal and interest. It just says interest. So the expense of the property is only the interest. So if you volunteer to pay the principal, that's not part of the expenses of the property. It's only the interest component. So it's not, So that's another thing with the principal and interest. The other thing with principal and interest is that when you run your loan up to about the 25-year mark, running at principal and interest, you might find that sometimes your property may now start to look after itself.
No, surely not. They don't do that. They don't do that. But that's also an interesting thing when you go to when you redo your loan, you've had it for principal and interest, and you got it an 80% LVR or a 70% LVR or a 90% LVR. When you 5 years on, hopefully it would have grown, and the LVR situation is a little bit different. Anyway, so we've covered off the basic strategies. I want to start talking about the more advanced and interesting strategy. I think actually this whole conversation has been thoroughly good and entertaining. We've got.
Can I pull it back and ask one more? I want to ask about fixed versus variable, Joe. So I think that's one thing that people are sort of. I think people ask a lot about that. They ask, should I go fixed, or because they're like, rates have gone up so much, and I'm going to go variable, or they're sort of saying people that are on fixed are cheering because. So what sort of consideration should people have when we're talking fixed versus variable, Aaron?
Yeah. So I'll just rattle off a couple of things. So some people are facing the fixed rate mortgage cliff. They're coming off the low ones to the high ones with 3 or 4% change. You can have problems with locked equity because you can't meet that lender's policy for getting more equity out. People are concerned about breaking, and fixed rates around how you can manage the type of property you're buying and your budget you're on to be able to think about if there's going to be any interest rate rises. So when you get a fixed, this combo is so advanced. When you fixed rates we can only recommend fixed rates as a budgetary measure, or we can't really play the crystal ball of what's going to happen with rates and stuff like that. So if you're buying a $500,000 house with a 4% rental yield and your surplus cash flow is very tight, it could be something to consider around having a fixed rate for a period of time so that you don't have variations in your repayment, so you know how to budget for that. When you have a fixed rate where currently with fixed rates, a lot of the legacy stuff is lower than whatever the current fixed rate is. So there's not usually a break cost. But if you have a high fixed rate and the current variable rates and fixed rates are lower than that, there typically is a break cost. So at the moment, we're in the reverse where there isn't too many break costs because the rates are going up all the time. Locked equity is a really interesting phase with fixed rates. So if you've got $200,000 owing on a $500,000 property and you're with a bank that's quite restrictive, you can't meet their new lending requirements, you would potentially have to break that fixed rate or just suck it up that you can't get the equity out for the period of time of the fixed rates.
Well, yeah, I always assumed if I was fixing a rate, I would be not able to access to the equity for 2 years or 3 years or whatever it was. So I did that. I got a property, I renovated it, and then I refinanced it into a fixed rate because I knew I couldn't extract any more equity out of it. And I knew that's it for this property. Yep. It's just going to be capital growth. I don't need any equity. So yeah, that's the way I assume. So you can go back to the bank and say, hey, I want to not break this. I want to keep the money, but I also want my equity out.
And you can do that via lending split. So you can keep your fixed rate in place and you can put another split on it as long as you can afford that lending criteria. Yeah.
Love it. Okay.
So just quickly on the variable you mentioned, well, you get flexibility with that. You can pay it off. You can get more money out. But the rates can go up. Some they might go down, but they go up. You can move and restructure easily. Offset accounts are usually in the main on a variable split, even though there's a couple of banks that will allow you to offset fixed. And you can, if you've got equity in a property and you can't meet your current lender's requirements, you can actually move it to another lender that gives you the equity out to go again. So I've had all. No, that's on variable. So if you have a variable rate, you can move banks to get the equity out if you can't match the requirements of the bank you're with.
Yep.
Yeah. And there's even the splits. You can even do a split between a certain percentage fixed versus variable as well.
That's right. So when you have splits, a split on a loan is a mortgage secured to that property, but then you have one BSB account number for your fixed and one BSB account number for your variable. And it's the same when you go for equity to buy property. You have your owner occupied BSB account number and then your equity BSB account number. So you can differentiate what's helping you buy property and what's your own occupied mortgage.
So to take it into like the real world, that's exactly what I did, because I was like, I want to have a savings. I want to build up a buffer of $80,000, and that's going to be off. That's going to be able to kind of pull out and not be fixed. The rest is going to be fixed, and then I'm going to have a $80,000 variable component that's going to be offset, and allows you to kind of change. But chat to your broker about that stuff, because it can be very useful, because you can lock away at X rate, and but that was before 11 interest rate, right? So
well, the market's talking. There's the amount of fixed rates that were happening, say beginning of last year, 2021 22 is not happening at the moment. So at the peak of the lowest of the low rates of fixed rates, there was like 50-50 variable, 50% fixed. Now it's dropped through the floor. Most new loans are variable.
Interesting. Well, let's jump to our next segment that is going to be all about advanced strategies. We're going to be talking trust. We're going to be talking structuring. We're going to be talking about the boring stuff that's incredibly interesting, where if you don't understand it, you kind of put it into the too hard basket. What we're going to do is take it out of the too hard basket and put it into the, oh, wow, that's actually pretty easy. I should use that for my investing strategy. A basket, a very well labeled basket.
There's nothing worse than going into a situation unprepared, especially when that situation is purchasing one of the most expensive assets of your life against a trained property expert in the form of a real estate agent. It's a scary thought, but it is a skill that can be taught. Do you want to learn how to become fully prepared when buying a property so you can get out there, buy your dream home or investment property without the fear of actually messing it up? Scott Agate, the founder and expert property negotiator at Hello House, has been helping people buy their properties by stepping in and negotiating with the agents and saving his clients tens of thousands, and in some cases hundreds of thousands of dollars. Scott has now decided to share all that he's learned over the past 28 years in real estate, so you can go out there and do the exact same thing on how to find a property, analyze that property, negotiate on that property, and transact on it to get the best results. He's created the Get Buyer Ready course, which is a step-by-step guide on how you too can become an expert property negotiator. It's the easy way of how you can avoid all of these agent games and get the best purchase price on that dream home or your investment property. The course is in short bites for busy people with no fluff at all. Just all the information you need to get buyer ready and secure that next property with confidence at the best price. Scott has been kind enough to give our community a massive discount with the link below. Sign up today before you even think about putting an offer on that next property, and it will be one of the best decisions you ever make.
Oh, hello. Welcome back.
We're
back.
Let's do it. I'm excited. This has been an unreal session. If anyone's got any questions, guys, throw them in the little comment box, and we've been flagging them, starring them, so we'll get to those at the end. But I've thoroughly enjoyed this so far. But I want to learn more about some of these advanced tactics. Jeff, what is the advanced tactic question that you have? The burning advanced tactic question you've got?
Well, I suppose it's around not so much what it is, but I suppose it's how do you extend your? I mean, you called it infinity borrowing capacity, but I think how do you keep extending your borrowing capacity if provided you meet the requirements? Like, talk to us about how trust structures work, Aaron. How they work and how they help us.
So there's two types of trust structures. So one is the self-managed super fund space, which is easy to understand. So we'll start there, even though it could be quite complex because of the superannuation legislation. But it's a trust that allows you to do the borrowing capacity in isolation and not look at your personal income except for the superannuation guarantee that's put into it and the rental income. So it's quite simple where it's got two major components of income to be able to get the borrowing, and it's ring fenced off. It's in its own little place, and grows quite nicely until retirement. The other type of trust and company structure is the one that's not inside of super and has a whole range of other bells and whistles that you would normally see in a current standard loan. You can borrow up to 90%. Depending on the trust, obviously, you borrow up to 90%. You can look at your legal and accounting structure things about protectionism, depending on what you're trying to do there. I've done some quite complex structures where the loan's in the person's name and the company owns the property recently with some of the banks, which has been quite interesting. Bit of the war story getting that one approved. Then there's your trust where you're the directors and your income helps support getting the property. So typically, if we break it down, if you're going to borrow money in a trust, you just go, cool, I'm gonna plunge into this trust thing. You've got your right advice from your accountant.
Wait, are we talking about SMSF or non-SMSF?
No, non-SMSF now.
Okay.
Yeah.
So we covered SMSF.
So I said SMSF. It's a little thing that's ring fenced off. SG's rent goes. Yeah, cool, done. Tick the SMSF off. Get your advice and all that stuff about whether it's right for you. But from a mechanism of borrowing, that's as simple as it gets. With regards to outside of super or just a standard trust and company structure, you have all the flexibility. You can construct. You can do equity, you can do redraw, you can have offsets as well. You can have all these funky things within that entity structure. There's a few things that you have to get your accounting advice and legal advice and all that stuff to be able to go forward with it. But from a borrowing capacity, when you go to buy a property in a trust, it's your own personal income and assets and liabilities to be able to support the borrowing in a trust, because you become the directors and the guarantors, and the bank will put whatever guarantees over you to be able to lend that money into that entity that's, say, newly set up.
So far, there's no
difference. Yeah,
there's no difference. Your borrowing capacity, you got to trust. It's still you. You're just the you're just the appointer. No, not the appointer. You're the So
now we're getting a bit boring saying all this.
Yeah, let's avoid the boring stuff. But so far, what you've said so far is just
it's standard stuff. All right, so it's just standard stuff. So, and it's the same when you have, say, even you want to go multi-trust. Like, you've got to have your own circumstances to support the borrowing in the trust, and if you go another trust, it's your own borrowing and the borrowing in the trust. What gets funky is that when you have multi-trust, there are lenders that if you're not using the income from that trust, you can exclude that trust from the next borrowing capacity.
So now we're getting interesting.
So
now we're getting very interesting.
First.
So I have one property, and I'm that single person, right? $160,000. I can buy, let's just say, 2 properties, right? Because you said 500,000. Let's say I've got my one property, but I can now borrow another 600,000 because I lost a dependent and a credit card. So I can now borrow $600,000. Are you saying that I can get a trust as an individual and then purchase a property in that trust, and then me as an individual still has $600,000 borrowing capacity, but I've spent that in my little trust here, and then I put this property and its trust aside, and then I go ahead and go to the bank, I've done that deal, found, negotiate, secured that amazing deal. And then I come back and say, hey, banks, I'm ready to go for another property. I have a borrowing capacity of 600,000. I would love to purchase another property in a trust. Is that, I mean, that's a simple way.
In the simple way. Now, it's always lender dependent. It's always lender dependent. There's a lot of banks that
didn't say no. So that's now getting interesting.
I'm going to say yes. So in simple context is yes. So how about we make it simple? But it is lender dependent. One of the big fours will not let you do that. They want to see everything. There's another big four that it's credits manager's discretion, and there's a bunch load of other ones that have all varying things, requirements. Some will exclude a trading entity, some won't exclude a property trust. There's a whole range of things there that gets into a bit of the science or artwork that you need to put some lending strategy around it. So this
what are the Can I ask you what some of the things that people get tripped up on quite regularly with that, or things that stop people from getting approved with those structures?
So
Was that a harder question?
So it depends on what type of trust. So if we look at trusts have like there's a discretionary, a unit, a fixed, a
Hybrid,
a blah blah, all that sort of thing there. That can change a whole range of mechanisms from accounting to lending. That's a consideration. So we always look at the trust deed and the separate setup. There's individual trustees to corporate trustees. So there's a big minefield in there. But you got to remember at the end of the day, from asset protection and stuff like that, if there's something wrong, they can always find the director, and the director is usually a name of a person. And with the lending, they'll lend it to the company, but you are the guarantor as the person behind it that has the income to support it. So that's the thing there.
Do the banks like it? Do they like lending? Because I guess the business of banking is to lend money, and it's become very difficult to lend money out. So when they see someone that says, hey, I want to do this whole trust thing, are they interested, a little bit more interested to say, hey, actually, we'll lend you money?
It's all, you'd have to say the bank is a bit more black and white. So if I look at a product sheet of Commonwealth Bank, for example, it'll say the type of borrowers we accept is individuals, a natural person. We can do companies and company trusts and these types of trusts. And it's really tick a box. It's not whether they like it or don't like it. It's just they treat it the same way. It's how it's judged its income.
And emotional.
Yeah, it's unemotional. I've got many trust loan applications going in. It's just a different. It's like you got the trust, and then you got the people behind it.
Computer says yes.
Yeah. And some trusts, if you got the trust set up the right way, some of the lenders will still go to 90% lending on it. They'll still do interest only. They'll still do construction loans and all that. The only thing you can do is
I'll throw this out there, and we sort of spoke. You don't have to, Aaron, but which lender will go to 90% or which?
It depends on the trust. So most of the time it's a discretionary trust that can go to 90%, and most lenders are accommodative of that.
And that's the typical trust that when people talk about trust, typically, unless they're doing a development deal, it'll be a unit trust in a development deal, because it's a fixed unit and it's people that you don't necessarily trust. But discretionary trust is typically what most property investors, like 90% of your applications. I don't know what percentage.
Probably 90% of my applications discretionary. We have a few unit trusts that have funky stuff.
That's what they call.
That's the other street name. Yeah,
it's the same.
Street name.
Street name.
Take your family on the street. There you go. So discretionary trusts. If you look at the lender's policy, discretionary trusts have a bit more flexibility on loan to value ratio. If you have a unit trust, I was talking to a lender the other day. They'll only go to 80%. So that's lender dependent as well. But in the main, it's that. But you have to seek your accountant's advice about what trust structure is right for you from there, because there's other implications other than lending as well. Even though most of the time it's for borrowing capacity.
So just to understand, I'm the salary person with $160,000. They got a kid, they can borrow 5. So I really need to be thinking about this before I purchase property number 2 and max out my borrowing capacity. Because if I know this next purchase is going to max out my borrowing capacity, I then buy that and then say, hey, I want to get a trust and create unlimited borrowing capacity. The bank's still going to look at you as an individual and say, Joe, you can't afford a trust right now. You need to have a better borrowing capacity. You can't afford it in a borrowing capacity standpoint. So I need to be thinking about this a couple of steps ahead. It can't be just, hey, I've maxed out my borrowing capacity. Let's get a trust and get unlimited lending. It's not as black and white as that.
No, and it's probably not even as black and white that you want to borrow and borrow and borrow and borrow and borrow and use multi-entity for that. There's particular reasons why you would hold it in your own name, and there's particular reasons why you would put it into a trust. Having it in your own name, if you're running the property negative, say you're on take my big lawyer or specialist position, they want the 4 million with the 1% rental yield, that's probably going to run a little bit more negative. And if you put that into an entity, that negative or that loss stays in the entity. You can't move it back to your own personal income. Yeah. So there's that whole accounting advice piece there, depending on what type of property, what type of income you're on, how you are structured. And then for the people that are on sort of the middle income or wanting to diversify it into the different ownerships and the trusts, that's going to be a different play on it. If you are starting to get restricted, trusts can be quite an interesting play. As you've been in the property investment for a while, you can diversify into that area. If you are owning property in your own name and you want to put it into a trust, that's a whole different ballgame of costs and things as well. So you've got to understand what your goal is before you start going into this. So you may need a tax deduction. So you put one property in your own name. So it's you're owner occupied with the investment property and then go into a trust. Or you might just want to put it all in trusts so that you can do a whole range of other things in personal lending land later on down the track.
Probably the key, one of the things that people say about trusts is the costs involved with operating. And
of course.
I sort of suppose say that's the cost of doing business. Like, I mean, if that means the difference when you borrow, well, I don't know, it can get, it's $2,000 to $3,000, which is still not, I mean, you can do it cheaper, of course.
So, and if you're used to doing if you're a PAYG person and you're used to doing your tax return and you're paying your $400 or $500, whatever it is that say you've got a couple of properties, and then you get hit with a $2,000 bill in a trust, it's a different fee structure there. If you're self-employed, obviously you're probably paying that already for your trading entities. If you've got a self-managed super fund, you're probably paying that too. So you've got to consider the costs associated with that, and especially if you want to go multi-trust, then you've got double it up.
Yeah. Also, I wanted to.
Yeah.
Oh, you
go,
Jeff.
You go, Jeff.
I want to know, because the elephant in the room, so to speak, and maybe it's not an elephant, but it could be in a more normalized rate environment where rates are sort of between 5% and sort of 6% roughly. Is it still, because is it sort of a myth, or is it true that it has to be at least, I suppose, paying for itself to be able to exclude it? Like, how does that work in a relatively normal interest rate environment? Does it still work?
So does it still work? Yeah. So if we are, so we go into a bank and the bank says it's identified that you've got a corporate entity. We need to see the financials. We need to see what's going on. Or I need an accountant's letter to be able to know it covers its own costs. Then it's coming down to the judgment of the accountant, and obviously they know what's going on with that entity and all that stuff. And typically speaking, if it's got a profit on the bottom line, it'll work, and away we go. So the way that accountant judges whether it's profitability or not is up to the accountant to sign that letter. If they don't sign the letter, you've got to put your trust financials on the table. This is pretty black and white.
This is a really good question. Now, what are we thinking here? Are we thinking we buy one trust per property, or do we load as many properties into the trust as long as we're under that tax-free?
Talk about it from a lending perspective, I suppose. Is that because
you can't really talk to the tax stuff accounting stuff is. But how do you see typically your more advanced?
We've got Jeremy coming in a couple of weeks.
Deal with the more advanced property investors that deal with trusts. Are they just loading them all into one trust? Are they loading them into one each? Is it 5 per deal? Like, how's it work?
All right. So I think you're to have a bit of to take it back a step with property. So we talked about buying properties that have capital growth and cash flow and things. So if you sit in the middle and you've got capital growth and cash play, so we've got the cash play to help the profitability, and there's usually some capital growth that you may want to go back and get. So if you hammer out your personal lending and a trust, you're probably going to hammer out your lending and not trap your equity a little bit. So you've got to have a play around what your borrowing capacity is and have a strategy around how much of it you want to use up in each particular entity you want to start borrowing in. Did that answer your question? So
no, not in a simple way, not in a way that simple man like me needs to understand.
Okay, so if you've got $1 million borrowing capacity with yourself and this trust that has no property in it, probably not good to go to $1 million.
No,
probably good to back it off a bit, so that and then stop and then watch your portfolio grow over time before you go, say, to another trust or another trust or another trust.
So
you probably, you can put more than one property in a trust. You can have 2, 3, 4, 10, 20, 30 properties in a trust. You've got to have what's your tax mechanism related to, say, land tax? What's your mechanisms around? Have I maxed out my borrowing with myself in that trust? Have I got the right? Do I need to look at diversifying into other trusts?
And why would you diversify into another trust from a lending perspective?
Because you can exclude the first trust.
Okay, there you go. Okay.
Yeah.
Yeah. So that's when I've now got $1 million. I've put $1 million into this trust, and let's just say we kind of tapped out our borrowing capacity. So when if I go back to that trust with the lender and say, hey guys, this trust wants to buy this property, it says, tell me all about this property. And it's like, no, I'm not. Well, you've maxed out your borrowing capacity. You got $1 million. You've already spent your $1 million. Oh, yep. Sorry, I gave you the wrong name. There's actually this new trust here I just created. This is my new trust. Let's put this under here. And they're like, oh, great. There's nothing in there. You've got $1 million borrowing.
You probably wouldn't have the conversation like that, though. You just feel like, hey, we're buying a different entity. It sounded very awkward, Joe. It's like going up. It's like, can you go out with me tonight?
Illustrative purposes.
Yeah. So,
I
know. Yeah. So you can, where the lender's policy allows, you can use diversification of more multi-trusts to help you build further. Lenders that probably investors that I hear on podcasts and I see, they come and they're nearly capped out, and you have to then think outside the box related to the borrowing capacity with trust structures from there. Can even be company structures, and I even think there's other funky ways to do things as well. But you get the property in a trust, then you can go to another trust. Then you can look at the lender's policies. If they're allowing you to look at it as a profitability thing, you can exclude that and then recycle your remaining borrowing capacity to keep going and going and going. What we find still is with any multi-property investor is that borrowing capacity typically can be unlocked, but it's the deposits that start to trap it up.
Yeah.
You also got, if you've got multi-entity play, you've got how do you move money between them and a whole range of accounting things that you
revaluing them all.
If you got Jeremy coming on, I'd be asking how do you move money between your multi-trust property portfolio?
Okay, we'll flag that. How do we remember this? Anyone who's on next couple of weeks when we have Jeremy on, flag this and play it back.
What question do we need to ask Jeremy? I'll send it to you now, Joe. What do we need to ask Jeremy?
How do you move money between one trust to another trust in a tax-effective way?
So this is super interesting because I don't hear anybody talking about this stuff because it's too complex. But I think you've really simplified this down to a pretty easy way to understand. But how do you kind of get started with understanding? How do you get started with this stuff? Like, how do you start?
How do you start?
There's a lot
you speak
there.
to Aaron first, or is that?
Yes.
Well, we came back to that quote at the beginning, that saying at the beginning that property investing is just a game of finance with a few properties thrown in. So you do need to get your finances sorted out. But even before that, you want to know what your goal is. Like, have you just become successful at business, become successful at your job, come into the realm of your major income? You've got some equity, you've got some cash. What is the goal that you've got for property investment? Like, trust lending is not for everyone. Super funds not for everyone. Property investment, I like to say it's for everyone. But you've just got to understand what you're doing and where you're going to go with it. Is it a lifestyle play you're going for, the legacy play, the just building wealth play, and you want to do something and then pay it down later, or sell it all off to retire and go around the world? So if you know what your goal is, that would help you with if you're going to put properties in your name. How does that work from a tax point of view? How are we going to, if you have the goal of 15 properties, you're probably going to need to look at structures. and go from there. So how do we get started? It's always good to talk to an investment broker if I want to shout myself out there, or other cool investment brokers. And then you've got to be linked up with the team. You need a good person. So you need someone looking at finance 100% of their time. You need someone looking at properties 100% of the time. You need someone looking at the tax and the structures 100% of the time, backing you up to understand what's going, understand what your next is.
I thought this question got asked about 40 minutes ago, and they're probably not watching, but that's okay.
I know where it's going from.
Is that so? It sounded like you did to kind of jump into tax planning with accountants. Is that sort of what you, which is unusual for brokers?
So when you got self-employed people are awesome. I do a lot of self-employed lending and a lot of multi-property lending, and with year-to-year variances with tax returns for self-employed. So if you want low-cost lending, you're going to have a 12-month tax return. And your last tax return, we may have already done all your property purchases in the first half of the financial year because your recent tax return makes that happen. But the second half of that year, you may need to do a little bit of planning because you've run out of path for this current time period. So then when
money on property.
That's right. So when you get into the second half of your financial year, you've now got some data around your profit and loss and your balance sheet for for your entities, that income. So you can start to predict where you're going to land for the end of the financial year. And if you can predict you're going to land at a better state than you were the previous year, your borrowing capacity can open up again. And with effective conversations with accountants and brokers, you can have the right balance between what are the add backs that the lenders allow and how much tax you're going to pay to keep you borrowing. And it's best off talking about that between January and the tax planning meeting, because if you've got, I had a message from a client of mine saying, I need to buy a car to offset tax. That can be good or can be detrimental to your personal borrowing capacity. Where there could be other mechanisms of all that stuff. So when you're wanting to buy property and you're going into a, say, tax minimization conversation, you probably need to understand where, like, if you do that, this is what your borrowing is going to be. If you do that, this is where your borrowing is going to be. And I like to get in early before those tax returns get locked away. And then I'm telling you can't do anything under low cost lending for that period of time. There's lending options out there for people that don't want to do the year-to-year tax returns, but they usually cost a little bit more.
Because your accountant cares about tax and tax minimization, but your broker cares about borrowing capacity and borrowing ability. Have them all talking together. So yeah, the fact that you actually sit down and chat with some of your clients, accountants, is super, super crucial. But yeah, have a team that is connected, I think, is one of the most it's very important, but make sure that they're not one of these one-stop shops that you keep hearing about. Like I see people, I see like in the Spruker environment. Hey, this is my company, ABC 123, and here's my conveyancing firm, ABC Conveyancing, and then 123 broker, and then 123, because that's where I start to see people not being incentivized correctly because they're not running their own independent businesses.
I love the interim tax return stuff with self-employed, because I don't know any self-employed person that doesn't want to grow their business or grow their wealth. Yeah, so always need to be in the accountant meeting where I can. Always offer it.
On this, I want to pull at a different thread, and it's completely not unrelated to lending, but it's sort of before we get into
that vegetarian thing again, Jeff.
No, not the vegetarian temple cafe. But I wanted to talk about, because I was thinking about, Joe, you and I don't talk as much about property investing these days. We sort of do, but we don't. We talk on this thing about it. But what is your thoughts, Aaron, on do people build wealth in property, or do they store their wealth in property? Like which, and I know it depends, but I'm just interested in your opinions on that. Like I just wanted to ask this question because it's kind of a very Aaron-based question, like about the why. So what are your thoughts on that?
Whybrow.
Yeah, thanks. That's a great point out there, mate. So you can store your wealth in property. And I remember doing a loan for an elderly person that needed to get money to get into a nursing home, and very cash poor but asset rich, and they were able to get the lending for it because of the backing. And then you've got people that have the balance of loans under control as they've developed over a period of time with the property, and they've got the cash flow coming off. And then you've got the people that want to extinguish the debt via whatever mechanism, selling down and holding on to as well. But then there's this other group of people, you could say there's some old money, like it's intergenerational wealth stuff. They've held on to this property's been in the family since the World War II or whatever. And that's a really interesting how to deal with that, or how to do things there. So do we store wealth in property? We can store wealth in property. Property does fluctuate in price. We've seen that in the recent times. But it's still, for me, it'll still come back to the goals and what you want to do next, because obviously I love to do the next thing for people. But yeah, I see everything from that to the people that just want to keep buying.
And what do you? And I suppose I'll add a bit more context, and maybe I didn't ask the question in the way that I thought I was, but I think because a lot of people are like, oh, you can make a lot of money in property and you can retire in 10 years and all this sort of stuff. I think that's great, but I think what people are missing out of is that a lot of people are making money in business or in their they're really sort of affluent for their jobs, and then they're taking that money and then converting it into property. Or buying property rather than the other way around. They're buying property and then they're becoming wealthy, unless you're an active property person. So I just wanted to, I suppose, throw that sort of insight out there. Do you agree or disagree, Joe? What are your thoughts on that?
Well, I mean, one of my favorite people is Charlie Vayler, and his quote to this kind of statement was, "I make invisible shit on the internet. I invest in property because I'm going to take the wealth that I create right now and lock it in, and lock that stuff into a physical asset that isn't going to disappear in any time soon." So yeah, for me is, as a business owner, yeah, sure, you can spend $10,000 on ads, but what if it doesn't work? What if you spend $100,000 ads? You don't get the result. You should be like, I speak to small business, like it's kind of a niche that I work with, is small business owners. And they tell me all the time, Joe, we've been doing this business for 40, 20 years, 30 years, 10 years, whatever it is. We're working our asses off 6 days a week, but we don't have anything to show for it. So why aren't we funneling our cash flow of our business into this little nest egg? So I think it's a great opportunity for small business owners to say, well, let's capture this stuff and stop making invisible shit on the internet. Well, keep making invisible shit on the internet, keep doing that, but then on the side, grow that portfolio out, because then in 10 years, 20 years, when you retire, you've got something, you've got an asset, because not all businesses are saleable. Like you can't just, everyone's like, oh, I'll just sell my business. Have you got systems? Have you got processes? Have you got a saleable asset that someone can just acquire? No, you don't. You've got a cafe that's going to take the rent and they're just going to do a fit out. It's not really $1 million business. It's just a cafe. Change the logo.
Let's just say I'm a worker. I'm a 9-to-5 worker, because not everybody people. Well, I suppose that those people, it's even similar to them, because you got to allocate your money and invest it somewhere. So I think you've answered my question in the sense of it's.
I'd put a couple of my $2 worth on that. You need to build wealth. If you're self-employed, you need to build wealth in your business to be able to, one beast funds the other beast. So you build wealth in your business, because business is a great, phenomenal asset. Everyone's heard of shares. There's shares, that's shares in a business, not in a property, so to speak. So you build wealth in your business and then you've got to understand your business. So you picked on Charlie's one about invisible stuff. You've got to understand your business. Like if the internet turned off tomorrow, you've got to understand how that's going to impact that business, or if we don't need that particular industry anymore. So that's a risk play. You are making money in your business and you're making money in your property portfolio. And same with the PAYG area, is that you might be a phenomenal nurse and save my life, but at the end of many years of working, earning multi-million dollars over that long period of time, what do you got to show for it? And sometimes when we're experts at what we do, whether we're experts at saving our lives, expert at doing ads on the internet, you need someone to help trigger you, whether it's this group or or a broker or someone or a property specialist, buyer's agent, all that stuff to spark your interest to go, okay, we've got to do some more stuff with our wealth, not just sit on it or spend it.
Would that even be the mate down your pub you're having a chat to one day, and you're just like, well, what are we doing this all for, Joe, or what are we doing it for, Stan, or I don't know.
What's your answer to that? What's your answer to the question, Jeff? What is your answer?
My answer is I think people expecting to become rich from property, it's probably not going to happen. Like you will, like it'll happen over time. Like I think a lot of people, and I suppose it's more our like TikTok kind of everybody wants things now. So I suppose that's what I was getting at. I think it's something that you can do over time, but it's not going to happen overnight unless you inject a whole bunch of cash from a business or from you're a highly paid professional. So that's my answer.
Property is always a slow burn, but it gives you options. I've heard and talked to people that because they had property investments, they were able to survive a problem with their business. Because they've had property, they've had the ability to survive relationship breakdown, estate problems, things like that, because they've got something to play with instead of not having anything to play with, whether they get sick or injured, all that sort of stuff comes into it. So property is not just to buy and wealth and all that stuff, but you just got to, it's for a purpose.
Yeah. It serves, it's there to serve you. Okay, cool. We've gone on for a very long time, and this is one of my favorite episodes. I'm going to rewind with this, go back to the start and listen to it, because I think there's so many little nuggets of gold here. So everyone,
particularly the last 10 minutes, Joe, you can probably skip that last 10 minutes. You probably will. That's right. The one where I was talking about.
It was good. It's all good. It's all good. This is super valuable. So let's jump into the questions, and we'll hit some of those up.
Go for it.
We've got way too many. So if anyone's got any other questions, boys,
we can answer these pretty quickly.
Yeah, boys, can you ask Aaron to talk to the benefits or downfalls of rent vesting versus buying a PPOR in the current climate? Now, does the current climate come into effect of this? How do you think about it?
So I have a little bit of terms. So I've got a couple of there's myself and a couple of other brokers that have been in the industry for ages in my business, and what's old is new again. So everyone's thought about these rent versus buy calculators. Like years ago, they were great. Guess what? Their rates are coming up to that area where they've become fashionable again. Rent versus buy, especially in some of the regional towns where the rents are higher and you're probably going to spend the same amount on a mortgage. Yeah. So the benefits around buying your own home where the rates go up is probably because you still have an investment, which is your own home. But rent vesting, so when you have your own home and rent vesting, that's where some of the borrowing capacity changes. So if you pay $1,000 a month on your rent, in an ideal world that's fictitious at the moment, there's not many of those around, $1,000 on your rent per month, the bank will accept that at face value at absolute $1,000 a month. If you're paying $1,000 a month on your mortgage, only a couple of lenders will take that $1,000, but in the main, most lenders will put a buffer on that, whether it's going to end up being $1,200 negative on your borrowing capacity, $1,500 or $2,000 negative on your borrowing capacity. So when you're rent vesting, it can help you leapfrog into, you can rent where you want to work, whether it's a high rise in a city, or you can rent where you can afford, buy where you can afford, or you can do the calculations to see whether your current area of living, it would be better for you to own versus rent. And if you forecast that out, there's other calculators out there to go, if you paid rent for 11 years versus a mortgage, that's another modeled calculator that you can do as well to see whether it would be beneficial to have the property.
The question is more like, I always thought it to be a borrowing capacity issue.
It is a borrowing capacity.
Yeah. I have $1 million. I buy a $600,000 house. It's not the same as buying a $600,000 investment property, which is bringing in me 5% yield. But my PPOR, I'm still paying rent. Like I still lose the income, which is less than the expense that I have of owning an owner-occ.
There's one major unfair advantage that an owner-occupied person has is the equity play to draw on for deposits.
Yep.
That's one major thing.
It's big.
And then your rent vestor has probably the benefit on the borrowing capacity side because of how the calculators are built.
Just do both. Be both. Just make more money and do both.
Yeah.
That's probably
Dos, what is it? Is it Mexican?
Porque nos dos.
Yeah, something like that. I've actually spoken a bit of Spanish, so not very well, apparently. This is an interesting one because it sort of talks to an average person. What is an average person? It's like the reasonable person test.
Well, let's use
average income.
Let's use that $160,000. Now, that's a single person with $160,000. I know that's.
I don't think that's average income.
That's not average income, but maybe for a couple it is, right?
Yeah. Probably,
Can the average person with the average income keep borrowing, building a large portfolio, and how your income? What?
How you can overcome those lending blocks that come up, or how can you overcome?
Well, structures is
what this
one.
been about. That's this
whole
session. That's all that.
So there's a couple of little things on that is to when someone gets to capping out on their borrowing capacity, say in their own name, there's this other thing that I throw out there called asset recycling. You may have to offload some assets, which offloads some debts and increases your borrowing capacity. Then if you go back into the borrowing space, you can then go into restructure it from there and things like that. If you own assets that have a high, say you've got, you're trying to be, you have mum and dad staying in the house, or you got a low rent or anything like that. So you might want to assess your portfolio and go, if it's got the capital growth, but my rent hasn't stayed in step, or it's not covering anymore, it's got debt on it, you might want to think about which asset you want to be able to recycle into being able to borrow again.
Love it. If anyone's got any other questions, throw them out. We've got a whole bunch here.
Was that a question?
Let's do some rapid fire, Jeff. I feel like you've got a whole heap lined up.
I've called them.
I'm seeing them popped up. Okay, yeah.
I've called them because they sort of got answered along the way. So
cool.
One of the valuable sessions.
Oh, sorry. Oh, yeah.
Cool. Here we go.
Curious as to if Aaron can explain why investment rates are generally higher than owner-occupier, besides because they can. Is there a way to get owner-occupier rates on investment lending? Or wheeling back to the start.
So I can probably shortcut that answer and say, yes, there are a couple of lenders that will allow us to, if we provide them an owner-occupied security and an investment security to the same lender, there are promotions at times that we can get owner-occupied rates across both. Owner-occupied rates can be on that property that you buy and you live in. You've got owner-occupied rates, and then you move out and you put a renter in there. You can keep the owner-occupied rates. You don't have to go and tell the bank that you've got an investment property. Now they're all listening to me. And why are they generally higher? It came back to the big review related to how mortgages are funded from sovereign funds and a few other things. So if you look at the market of Australia of the mortgages, if you've got a tilt more to investor lending versus owner-occupied, in Australia, most people will pay their owner-occupier and sacrifice their investment. So no one in Australia is going to sacrifice where they live. So they're always going to pay that. So it's a stronger investment. If you're going to invest into, if you're going to loan money to someone that's an owner-occupier, they're stronger in the ability to pay from a risk point of view. Yeah. Why is it investors slightly higher risk? And there was a lot of tilt when they brought in this remaining principal and interest lending stuff, is that if you've got Australia as a big investment and you've got more interest only lending versus principal and interest lending, are you wanting to invest in it? It's getting a little bit dicey because no one's paying down the debt. So what about what's going on? So investors, it just goes down the lines. Owner occupied pays their debt and will always, even in trouble. Investors, yep, it's there. And then interest only, it's there too. So it's just a risk factor thing.
Yeah, well said.
What about this one? Can you buy your first property in a trust with a low doc loan?
Yep.
There you go.
Yep. Yep.
Yeah, you can. Go do it. No, don't.
Easy.
No,
we can even do commercial property at a low LVR on a self-declaration in a trust, in a company, whatever.
Self-declaration. And this is where it starts to get a bit spicy and dicey, where
Wow.
You are still in control of your financial destiny, and you do
eyes
still,
wide
just
open.
because you can borrow doesn't mean you should.
That's right.
And you'd be going to your more commercially sort of or smaller sort of lenders that are, I suppose, they specialize and they're willing to take on and probably paying a premium for that, I imagine.
So we can do business activity statement lending and accountant's letter lending inside a trust or even for your personal name.
What sort of LVRs? Are we talking 60 or 70% LVR?
We can typically go up to, most of the time every lender will go up to 80%. And some will go up to 90%, but they cap out at a maximum loan amount. So some will be like, you can do accountant's letter up to say $750,000 worth of lending, or 90%, whichever comes first.
Yep. This is an interesting one. I think it's pretty similar, isn't it, Aaron? But correct me if I'm wrong.
It's the same. You've just it's the way that you so interest on your owner occupied and investment outside of a trust is about there. You just have to, when we put pricing requests into a lender, we just have to say it's the company versus something else, and you may see that your trust lending interest rates will go off on a tangent where your other lending interest rates may not, and it's just the same process that we talked before. If your trust lending is going outside the normal requirements, you have to ring them up and get a discount. Bar that, there's a couple of lenders that will load your interest rate for trust lending. I've got two that will add 0.75 on your rate for investment trust lending, but there are plenty out there that don't do that.
Wow. Yeah, it'd be great not to be hit like that. One of the questions that came through before was, let's paint a kind of picture of a scenario. I have minimal borrowing capacity, say around $150,000 to $200,000 left, but there is a good amount of equity, say $250,000. How can I make the most of this?
Okay, so if we got borrowing capacity of 200,000, yeah,
yep,
150,
and we've got equity of 150.
No, yeah, borrowing capacity of 200, and then I've got equity of 250,000. So
cool.
Can't really. I mean, there's Go on. Sorry.
So income determines your borrowing.
Yep.
Equity is just a thing that we can go to if we have it to be able to borrow it back. So we got to borrow it back by providing our income. So if you've got $200,000 worth of borrowing capacity and $250,000 worth of equity, you would only be able to pull out $200,000.
Yeah, because that's
which is basically
and then your income allowed.
And then you're capped out.
This is where the interest only kind of thing goes. Like, I've got 250,000. Well, I've been making these principal interest and I've been paying that down. Well, now you need to go and ask for that money back. Whereas if it's interest only, you don't have to ask for that. You don't have to ask for that money back. The person can go to the bank and say, let's say they have enough income there and $200,000. They can go to the bank and say, I want my $250,000 out. They're going to say, no, well, we're not going to give you the full 250. We'll give you 200. And then they've got their $250,000 borrowing ability, then throw in 200,000. That's a $450,000 purchase, essentially.
So just to break that down a little bit, so I totally get it. If you've only got $250,000 worth of borrowing capacity and you've got $250,000 worth of equity to get out, you can go to the bank, get your $250,000 out, but you won't be able to borrow anymore. So your property selection is going to be restricted. Now, the way that you could do this is what is your overall goal? What is your overall income? And is that property that's got the equity a ball and chain around your borrowing capacity? And maybe you could unload the debt, increase your borrowing capacity, and then see what you can do. Maybe you need more high yielding properties. Maybe you need middle properties that have some growth, or maybe that level. That's where I was going to go.
That's very good.
What you could probably, I mean, I would imagine it depends on who this person's going to. If they're going to the average run-of-the-mill broker, I reckon Aaron could find a lender. So you'd get out that 100K, 150K, and then this is what I call a multi-lender. So then you've got your deposit, and you go to First Mac or whatever it is, or you do it. You pull out that equity in a way that, or you reset loan terms. You do all these sort of things. And then you've got your deposit, and then your borrowing capacity might sort of be able to be increased by somebody who knows how to work the strategy.
Yeah. that you hit the nail on the head. So increasing loan terms will help you with the capacity and the borrowing.
Also increase the amount of interest you pay, but
and the longer time.
Not
if that's one lender that's saying you only got that amount of money, that's cool. We probably can get that deposit there, leave everything where it is, and then we'll go get the borrowing somewhere else. Most of the time when I'm dealing with property investors, it's usually it's either an asset recycling thing, it's a structure thing, or it's a deposit thing. Typically, we can find a way to do something, but everyone's got to be willing to do it, but it has to match the goals they're going after.
Boom.
Can trust work that way? I think the answer is probably no. But
so can he pull out the $200,000 of equity and then go 80% LVR in a trust for a property at $1 million?
Yes.
Probably not. But
yes. So you could go pull out $200,000 of equity out of a property that you own.
Yep.
And you can fund that as your contribution to the trust. And you can, let's say there's no other costs. Say we can get an $800,000 loan in the trust. Obviously, there's costs. We get 200 plus 800. There's $1 million. Away we go. But you've got one property holding into an entity that you've got to manage within that entity, and then you've got the potential expense back for your $200,000 equity loan that you pulled out of other assets.
Yeah, you still have to service the loan, but on paper it works. Oh.
Yeah. If you own the entity and you've got personal money and you own the entity, you can move it wherever you want. When you start a business, you probably got to put some money in to get it going. It's the same principle when you're doing trust stuff.
I think the challenge maybe if you're buying $1 million house though is going to be the yield on that. It may not sort of pay for itself.
I feel like they were using round numbers there, Jeff.
Okay.
Yeah, but also, I mean, that comes into the factor of everything, right? Like this is what you're doing, but the fact that you can actually do it is the more interesting thing. But then, yes, you can do it, but can you afford to do it? Are there any kind of really key point questions to go to, Jeff? Because I am cautious of time and
I think we're good. Like we've covered off so much. And
any cheeky?
I do have one, and I'm not sure how this is going to be answered because I'm just not sure. But can anyone speak to about projects and subdivisions as a ballpark? What does the borrowing capacity need to look like for a builder / subdivision project? Is there additional costs to consider? How does the lending for this kind of project look?
Mm-hmm. Well, you can do it as a full doc and put all your income on the table and do all the borrowing capacities that way, whatever the lender is, or you can do it as an asset lend under the private funding, and you won't need to show the income. You just got to show that you have the right loan to value ratio.
Yep. And
so it's hard to answer that one.
What's the other alternative without telling the bank that you're doing a subdivision project?
So if we take make a really simple one. If you're buying a big block of land with a property on it and you can rent it out in single repair, that's cool. Go for it. Get it as a short-term rental. Once you've settled on it and things like that, you just got to be mindful that the bank, if you're going to change the structure or anything with the bank and if you need the bank's backing, you're going to have to tell them what you're doing, and if you want to borrow the money, you got to borrow the money, and they'll probably control the funds and do all that if it's a standard resi big block subdivision thing. And when you finish the subdivision, you've got to put it all in there and get all done. It can take a bit of time, but it's not out of the way. I'd have to see more details.
Yeah. So get it done.
Jeez, I said about 2008. Here we come. Oh, jeez.
2008.
Yeah, exactly.
The interest rates were up there in 2008 too.
Yeah, I think it could be somebody from Twitter, the property bears that have infiltrated us.
There you go. This is called lending strategy, people. This has been an unreal session. Aaron, how can people learn more about you, from you? How do we get more Aaron into our eyes and ears? I want to learn more. I want to know more. I need a good broker. I need an investment savvy mortgage broker, because that's what we're all after. What do we do?
Interesting visual there into our eyes and ears. I know what you mean. Everybody says that, but yeah.
No one says that.
Well, you got all the... There's all the basic things. You obviously can reach out to me, send me an email, message, all that sort of stuff, and we can get you all we can hook a brother up, sort of thing.
Otherwise,
you can jump on, like, my website's got a wealth of resources on it. I am on a property podcast as a sponsor. You can learn more bits and pieces there and see me there. I like to do a few videos myself occasionally to educate people. You can search me on hashtag bagpiping mortgage broker. All my content I've ever done is on that hashtag, Google, LinkedIn, whatever. But
are you on TikTok?
I am on TikTok now, called the Bagpiping Mortgage Broker. I'm on TikTok, so that's pretty cool. But yeah, if you really want to dig into a strategy, let's jump on a call together and see where it goes.
Yeah, I would do that. If you are a property investor that is looking to build a property portfolio, Aaron is one of the brokers that I use for a lot of people that have a very, like, that are serious about making a real portfolio, having a real crack at property investing. Have a chat with Aaron and get that strategy piece done. It needs to be in conjunction with all your other professionals. But if you get everyone talking together, it's going to be super valuable. So big shout out to Aaron and the work that he does at DNF and the amazing team. He's got an amazing team there of people that help him out as well, that are in the background helping out run it.
The plaudits are coming through. People are
loving it.
So I just want to say thanks for offering you 2 hours of your Wednesday night, and we at fairly short notice as well, Aaron. Thanks for jumping on, and it's a great. I feel we've left a lot on the table, so there probably will be another session in 3, 6 or whatever it is. But I'm excited to see. Like, I feel like your business is going from strength to strength, just because you've got a great team behind you as well, and people who you, I suppose, are helping run the business with you as well. So it's great to see. It's really, and you just genuinely want to help people to achieve their financial goals, which is just what we'd love to do as well.
Oh, absolutely. I appreciate you guys having me back on.
It will be on YouTube. Yes, yep. YouTube.
What's the business name, Aaron?
Business name. So if
you're
going to Diagnostics and Finance, or dandf.com.au, that's the business name. You can Google me, just search for Aaron Whybrow. You'll find me there too. So yeah, Diagnostics and Finance. The team made up of, I've got 5 brokers and 4 support staff. So we have plenty of capacity to help everyone. Well, I don't want everyone, but property investors. Every
property investor.
If you can't help them, you'll tell them how they can be helped, I imagine.
Nailed it.
Yes,
unreasonable amount of value. That was unreal. Thank you very much, Aaron. Let's go do it, guys. Let's go build a property empire and go buy a property to start with, get the right strategy, and make it happen. Thanks, guys.
Cool.
Love your work, team. Thanks, everybody.